Welcome to the Deep Dive. Today, we're taking a close look at Stanley Druckenmiller. He's, well, a true legend in finance, isn't he? Often called a macro maestro.
Absolutely, and for good reason. His long-term track record is just phenomenal. Think about it. 30% average annual returns at Duquesne Capital?
For 30 years.
Yeah.
And crucially, without a single losing year. That's almost unbelievable in that world.
It really is. Plus, you have his time managing the quantum fund with George Soros, navigating some massive global economic shifts. He's seen it all.
He really has. So what we want to do today is really dig into his wisdom, look at his career, his core investment philosophy, some of those famous trades.
And crucially, his recent outlook, particularly looking towards 2025. The goal here is to pull out actionable insights, things you can maybe apply or at least think about in today's, let's face it, pretty complex financial world.
Exactly. We know you want deep knowledge, you want it efficiently, and you're looking for those aha moments without getting swamped in jargon.
Right. So let's try and unpack Druckenmiller's key ideas clearly and hopefully in an engaging way. We'll start at the beginning, the making of this market titan.
Okay, where do we begin? Early life.
Yeah, let's start there. Born in Pittsburgh in 1953. One interesting detail is that his parents divorced, and he moved around a bit as a kid.
And you think that early exposure to change might have fostered adaptability later on?
It's possible, isn't it? Adaptability is certainly a hallmark of his investment style, and something else his mother really encouraged reading.
Which became a lifelong thing for him, right? Fostering that continuous learning we hear about.
Exactly. And look at his academic interests, math, sure, but also literature and history. That's quite broad.
Yeah, not your typical finance bro starting point, maybe. How does that feed into macro investing?
Well, think about it. Macro isn't just numbers. It's understanding how societies work, how politics influences economics, historical cycles. That diverse background perhaps gave him a richer framework for that kind of top-down analysis. He himself stressed drawing insights from lots of disciplines.
Makes sense. So he graduates from Bowdoin English and economics degrees. And there's that fun fact about running a hot dog stand.
Yeah. With Lawrence Lindsay, who later advised presidents, goes to show you never know where people will end up.
True. Then he starts a PhD in economics at Michigan, but doesn't finish.
Right, he pivots. Leaves academia to become an oil analyst at Pittsburgh National Bank in 1977. And that seems like a really key moment.
Moving from theory to practice.
Precisely. Getting hands-on with practical finance, seeing how economic forces play out in a real market like oil. That's likely where the seeds of his macro focus were truly planted.
And he rose quickly at the bank.
Very quickly. Head of equity research within a year. Shows sharp analytical skills right off the bat.
Then comes the big leap, founding Duquesne Capital Management in 1981. He was only 28.
Yeah, with just $1 million to start.
Yeah.
And crucially, he focused on macro investing from day one, that top-down view.
Which wasn't necessarily the standard approach then, especially for a small new firm.
Not at all. He had conviction early on in looking at the big picture interest rates, currencies, economic trends, rather than just picking individual stocks based on their fundamentals alone.
And it worked. Duquesne started racking up consistent gains.
It did. That early success got him noticed. He started consulting for Dreyfus Corporation in '85.
And by '86, he was actually heading the Dreyfus Fund while still running Duquesne.
Wow, quite the workload. But that period really validated his macro strategy. It showed his framework could deliver results independently even before the Soros partnership. That track record is what opened the door to quantum.
Okay, let's talk about that Soros partnership. Joining Soros Fund Management in 1988 as lead portfolio manager for quantum, that must have been intense.
Oh, incredibly intense. Quantum was known for its aggressive, high-stakes, often leveraged bets on global macro events. It was a huge step up in scale and pressure.
So he's already got the macro chops, but Soros adds another dimension.
Definitely. Soros provided this incredible platform, a massive capital base, and a partner who thrived on calculated risk-taking. It was an environment that pushed him.
What were the key takeaways from Soros? That asymmetric risk-reward idea comes up a lot.
Absolutely central. Soros' famous line, "It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong." That became gospel for Druckenmiller.
So structuring trades where the potential upside vastly outweighs the downside if you're wrong.
Exactly. Limit your losses ruthlessly. Maximize your gains when your analysis pans out.
And the other big Soros lesson.
Yeah.
Betting big with high conviction.
Yes. The go for the jugular or takes courage to be a pig idea. When you have a high conviction trade, don't just nibble. Make a significant, concentrated bet.
That's a direct challenge to traditional diversification, isn't it?
Very much so. Soros really reinforced the power of concentration when the odds, based on deep analysis, are strongly in your favor. And during this time, Druckenmiller navigated huge events, German reunification, the Japanese bubble bursting. Soros gave him the scale and perhaps the psychological backing to act decisively.
But then in 2000, he leaves quantum and goes back to focusing solely on Duquesne.
Yeah.
Why the change?
Well, that departure came after some pretty significant losses during the dot-com bust. Tech stocks hit quantum hard. He's been quite open about it.
A difficult period, no doubt.
Absolutely. Returning to Duquesne was about perhaps regaining full control, rebuilding based on his core philosophy after that bruising experience.
And rebuild he did. The track record after returning to Duquesne is just stunning. That 30% average annual return, no down years, assets ballooning to over $12 billion.
It cemented his legacy, just incredible consistency over such a long period. But maintaining that level of performance, especially with such a large capital base, takes a toll.
Which led to the decision to close Duquesne to outside investors in August 2010. That surprised many people.
It did. He talked about the immense stress, the high emotional toll of constantly needing to deliver top-tier returns and not wanting to disappoint investors, even slightly. It wasn't about poor performance.
In fact, didn't the fund actually recover from a slight dip that year before closing?
That's right. It was down about 5% when he announced the closure, but he made a successful bet on a market rally driven by anticipated quantitative easing QE. So he finished the year slightly positive, a final demonstration of his skill, even while winding down.
So it was more about the personal pressure and the difficulty of generating those kinds of returns at that massive scale.
Exactly. He then transitioned to managing his own personal wealth through the Duquesne family office, which he still does today.
Okay, what a career arc. Now let's really get into the nuts and bolts of the Druckenmiller Doctrine, his core investment philosophy. It starts with that macro lens, right?
Fundamentally, yes, it's top-down global macro. He's looking for the big shifts, economic trends, political changes, and crucially, liquidity conditions that will shape markets globally.
And the goal isn't just to understand the present, but to anticipate what's coming.
Precisely. His goal, as he put it, is to anticipate changes not yet expected by the market, not yet priced in. That's where the real opportunity lies.
Which connects to that key principle. Never invest in the present. He's always looking ahead.
Always. He emphasizes visualizing the situation 18, even 24 months out. An early mentor apparently drilled that into him. The market prices things based on future expectations, not today's reality.
That requires foresight, obviously, but also confidence to act before everyone else catches on.
Absolutely. And it's not just quantitative. He stresses understanding the interplay of societies, politics, history, drawing on that broader knowledge base we talked about.
Now, given his reputation for big bets, this focus on how much can I lose is really interesting. Capital preservation first.
It seems counterintuitive, but it's the bedrock. It's defense-first thinking. By obsessively figuring out the downside, by limiting potential losses, he actually creates the freedom to be aggressive when a high-conviction opportunity comes along.
So managing risk isn't about avoiding it. It's about controlling it so you can take bigger swings when appropriate.
Exactly. He learned that asymmetric risk-reward from Soros, right? If you suffer a huge loss, getting back to even is incredibly hard, so protect capital relentlessly.
How does he do that practically? Stop losses? Position sizing?
All of the above. Strict stop-loss orders, careful position sizing relative to his conviction and the potential downside, and crucially, a willingness to cut losses quickly. No ego involved. If a trade isn't working, get out.
So that initial risk assessment is like buying a license to be aggressive later.
That's a great way to put it. Once he knows his maximum potential loss is contained, he feels empowered to bet big on those fat pitches, those rare, high-probability opportunities.
Which brings us to conviction and concentration. He's famously not a fan of wide diversification.
No, he's called it probably the most misguided concept everywhere. His view is, if you really, really see an opportunity based on deep analysis,
Put all your eggs in one basket and watch the basket very carefully.
that's the quote, though always with that rigorous risk management underneath. His concentration is usually thematic, tied to a strong macro thesis.
But he does use diversification strategically, doesn't he? It's not like he holds only one asset.
Oh, for sure. He uses diversification to hedge risks between different asset classes, maybe express related but less correlated ideas, construct a more nuanced overall position. But It's a tool, not the core strategy. It's quality of ideas over quantity of holdings.
And given how fast markets change, flexibility is key. He's known for being nimble.
Hugely important. Intellectual flexibility. He's willing to completely reverse a position if the facts change or if he realizes he made a mistake. No stubbornness.
He even talked about sometimes buying first, analyzing later.
Yeah, for certain fast-moving situations. Get a small position, get in the game, feel the market, and then decide whether to scale up, scale down, or get out based on how things evolve and further analysis.
That 1987 crash example is amazing, flipping from long to short mid-panic.
Incredible agility. It shows his thesis is always a working hypothesis, constantly tested against reality. It's not dogma.
And market timing. Many say it's impossible, but he believes in it.
He absolutely believes it's possible and necessary, driven by macro conditions, geopolitics, and especially central bank actions.
Oh, the Fed. He seems to constantly scrutinize the Federal Reserve.
It really does. He famously said, earnings don't move the overall market. It's the Federal Reserve Board. It's liquidity that moves markets. That's a core belief.
So understanding and anticipating Fed policy and the resulting liquidity flows is paramount for him.
Absolutely critical. He's often been a vocal critic of Fed policies, questioning their focus on engineering a soft landing or the rigidity of their guidance. He thinks anticipating policy shifts or even policy errors is key to major market moves.
Underpinning all this is that idea of being a perpetual student.
Yes, a relentless commitment to learning, refining his frameworks. He's known for an intense work ethic those early mornings. He learns from every trade, especially the mistakes.
Like the dot-com bubble experience.
Exactly. His advice to young investors reflects this. Prioritize passion, find mentors, get real-world experience that matters more than just degrees. It's about constantly questioning, evolving.
And the final piece, maybe the hardest. Being unemotional.
The discipline to be dispassionate, making decisions based purely on analysis, not fear or greed. Easy to say, incredibly hard to do.
He admits he fell prey to emotion in the dot-com bubble, right? FOMO, fear of missing out.
He does. He knew it was a bubble, intended to sell, but got caught up watching others make money and jump back in near the top. Lost $3 billion, a painful lesson.
And that led to his departure from Soros.
Yes. It powerfully reinforced the need for emotional control and strict risk limits. He really admired Soros for being, in his words, the best loss taker he'd ever seen. Focus on the process, not the outcome of any single trade.
Okay, that's a deep dive into the philosophy. Let's talk about some of those legendary trades. The 1992 sterling short break in the bank. Iconic.
Truly iconic. Druckenmiller was the main architect behind that massive bet against the British pound staying in the European exchange rate mechanism, the ERM.
What was the thesis?
Simply put, he believed the pound was way overvalued within the ERM's required bands, and critically that the Bank of England didn't have the firepower or the political will to defend that peg indefinitely.
So they built a huge short position.
Huge. And Soros encouraged him to make it even bigger, really lean into that conviction.
Then came Black Wednesday, September 16th, 1992.
Exactly. The UK government was forced to pull the pound out of the ERM. It depreciated sharply, and the Quantum Fund made, reportedly, over $1 billion.
Just incredible. A perfect storm of macro analysis, political insight, and decisive action.
A textbook example of his approach working on a grand scale.
What about navigating the 87 crash? That sounds like pure survival instinct mixed with skill.
It really does. His initial call was wrong. He went long just before Black Monday, thinking the sell-off was done. A big misjudgment.
But he didn't freeze.
No, he rapidly reassessed, realized his mistake, called it terrible, and then did a complete 180. Liquidated the longs, went aggressively short right into the teeth of the panic.
And managed to profit on the day.
That's the report. It just showcases extreme mental flexibility and the ability to execute under unbelievable pressure.
Okay, the dot-com roller coaster. More complex, with ups and downs.
Very much so. In '99, he was initially short tech, but then saw the sheer momentum.
And pivoted to go long.
Yeah. Rode the wave, and Quantum had a great year, up 42%. But then came early 2000. He recognized the bubble signs, knew it was overvalued.
Got sucked back in by FOMO.
Exactly. Watched others still making money, couldn't resist, bought $6 billion in tech stocks near the peak, lost $3 billion in weeks.
Ouch. That was the trigger for leaving Soros, right?
Yes. A brutal, self-inflicted wound, as he describes it. Emotion overriding his own rational analysis. A profound lesson learned the hard way.
And he bounced back even later that year.
Showed his resilience. Made a smart, profitable bet on U.S. Treasuries later in 2000, driven by election uncertainty. Duquesne gained 40% in Q4.
Then comes the 2008 crisis.
Ah,
A chance to apply those macro skills again.
and he nailed it. He saw the crisis coming, the unsustainable leverage, the cracks in the housing market, positioned Duquesne defensively.
Shorting financials.
Primarily, yes.
Yeah.
The fund performed very well in 2008, a huge validation of his macro approach and his ability to navigate and even profit from major crises. You could see the lessons learned from 2000 applied there, staying rational, focusing on the systemic risks.
And that final trade at Duquesne in 2010, the QE bet.
Right. Even as he was closing the fund, it was down slightly. He anticipates the Fed launching QE, bets on the resulting market rally.
And turns a small loss into a small gain for the year before shutting shop.
Exactly. A perfect final example of his core focus, central bank policy and liquidity drive markets.
These stories are fantastic illustrations.
Yeah.
Pulling it all together, what are the timeless lessons we can extract? The core principles for any market.
Okay, let's summarize. 1, follow the data, ignore the hype. 2, always look ahead, never invest just based on today. 18-24-month view. 3, liquidity and central banks are paramount. Understand them.
4, bet big on high conviction ideas. Concentrate your capital wisely. 5, capital preservation first. Always ask, how much can I lose?
6, be flexible, be adaptable. Your thesis isn't sacred. 7, keep emotions out of it. Easier said than done, but crucial. 8, never stop learning. Be intellectually honest.
9, think independently. Be willing to be contrarian if your analysis leads you there.
Those really seem to be the pillars of his success, principles that apply whether you're managing billions or your own savings.
He also seems to have a healthy attitude towards mistakes and humility.
Very much so. He says great money managers talk about their mistakes openly. Embarrassment is a great motivator, is one of his lines.
The dot-com loss is the prime example, right?
Yeah.
Even the best can succumb to emotion.
Exactly, but the key is how you respond. He took time off, reflected, recalibrated, and came back stronger. That resilience is vital. And again, admiring Soros for taking losses, well, it's part of the game.
And mentorship clearly played a big role for him.
Definitely. That early mentor at the bank, focusing him on the future and the Fed. Then the transformative partnership with Soros, learning about risk, conviction, psychology.
His advice to young investors reflects that, doesn't it? Passion, mentors, real-world experience.
Yes, he values those deeply, sometimes more than just academic credentials. He sees investing as an art honed through passion, apprenticeship, and developing key traits: flexibility, independence, competitiveness, curiosity, self-awareness.
Okay, a fantastic grounding in his philosophy and history. Let's turn our attention to the present and future.
Yeah.
What is Druckenmiller's compass pointing towards for 2025? What's his read on the current economic landscape?
Well, based on his comments in late 2024, early 2025, he sees 2025 as pretty complex, requires vigilance. He acknowledged some near-term stability in the U.S. economy, maybe excluding housing, late last year.
But he wasn't optimistic long-term.
No, he leaned towards the hard landing camp later this year, meaning he saw potential for a significant economic slowdown possibly hitting in 2025. He's quite skeptical about the Fed achieving a soft landing.
Why the skepticism? Inflation concerns.
Big time. He's worried about inflation possibly re-accelerating, drawing parallels to the 1970s, and he sees structural challenges in the economy. So overall, his outlook seems cautious, demanding selectivity and adaptability.
And his views on inflation, rates, and the Fed specifically, still critical.
Oh, absolutely. Very concerned about inflation resurgence, very critical of the Fed's focus, maybe obsession with a soft landing, and what he sees as their inflexibility, their reliance on rigid guidance.
Worried about them cutting rates too soon.
Yes, especially with financial conditions, in his view, still relatively loose. Remember, in late 2024, he actually revealed he was short the Fed, holding a significant short position in 10-year U.S. Treasuries. That's a direct bet against their policy stance at the time.
Based on his reading of history and potential policy errors.
Exactly. He expects potential volatility driven by policy moves.
He's also sounded the alarm about U.S. budget deficits, calling it a potential trust moment.
Yes, he's very concerned about the deficit running at around 7% of GDP, even near full employment. He thinks that's unsustainable. He's warned about a potential trust moment, maybe late 2025 or early 2026.
Triggered by what?
Potentially by the large amount of corporate debt needing to be rolled over around then. If confidence wavers, if foreign buyers step back from treasuries, you could see a sharp spike in yields, maybe 6-7% on the 10-year. Failed auctions could be a catalyst.
And long-term worries about entitlement spending, too.
Yes, those slow-burning fiscal issues are definitely on his radar, alongside geopolitical risks, adding another layer of uncertainty.
Shifting gears slightly, what about technology, specifically AI?
He sees AI as massively transformative, on par with the internet, calls it an existential threat if you don't adapt.
He was early in NVIDIA, wasn't he?
Yes, got in relatively early, partly thanks to insights from younger colleagues. But he did reduce or exit the position in 2023, citing valuation. He's since said he regrets that timing and is interested in getting back in at the right price.
So, bullish on the theme, but cautious on valuation and picking winners.
Seems so. He thinks beyond the core infrastructure players like NVIDIA and Microsoft, it's hard to know who the ultimate winners will be. Expects lots of competing models. And interestingly, he believes human intuition will still be crucial, working alongside AI in investing.
Given all this, the macro worries, the AI potential, how does his portfolio look? What are the themes for 2025 based on Duquesne family office holdings?
Well, looking at public filings gives us clues. Historically, big tech like Microsoft, Amazon. More recently, yes, AI plays, though NVIDIA position has been dynamic. Also, emerging market e-commerce like Coupang, gold stocks often feature as a hedge.
Anything stand out from more recent filings, say late 2024, early 2025?
Some interesting names popped up. Philip Morris International, maybe a defensive play with a transformation angle. Coherent Corp Tech and Industrial Materials, Natera Diagnostics, even a regional bank ETF, KRE, suggesting maybe a tactical bet there. And he's mentioned interest in anti-obesity drugs.
And the direct macro bets.
Still, that short position in 10-year treasuries, as of late 2024 anyway, and generally bullish on gold as a hedge against uncertainty and potential policy mistakes.
Now, it looks like a strategy of capturing specific growth stories while actively hedging those big macro risks he sees. Dynamic allocation.
That seems to be the approach, balancing long-term themes with current valuations and the evolving macro picture.
He also uses those specific signposts like the 3 death nails. Can you remind us what those are?
Right, the 3 death nails for risk assets, in his view, are simultaneously rising interest rates, a rising U.S. dollar, and rising oil prices. A toxic combo. He noted 2 were up in late 2024, and oil was maybe looking wobbly.
Anything else he watches?
Market breadth is another big one. If a rally is driven by just a few stocks, narrow leadership, he sees that as a yellow light, a warning sign. And of course, always watching the Fed, ready to capitalize if they make what he perceives as an error. These are practical tools he uses to gauge risk and opportunity.
Okay, this has been incredibly insightful. Wrapping up our deep dive on Stanley Druckenmiller, it feels like his enduring success really boils down to a potent mix.
It really does. You've got the macro foresight, that ability to see the big picture trends. Then there's the discipline, risk-taking, capital preservation first, but allowing for bold, concentrated bets.
Plus that crucial adaptability, the flexibility to change course. And underpinning it all, that relentless drive for continuous learning and intellectual honesty.
Absolutely. His career offers so many actionable lessons for anyone navigating today's markets, let alone thinking about 2025. It's about combining that big picture thinking with meticulous risk control.
And staying flexible in a world that seems to change faster than ever.
Couldn't agree more.
So perhaps a final thought for you, the listener. How might Druckenmiller's focus on anticipating the future, understanding those deep economic and political currents, and managing risk rigorously inform your own approach to the markets? His interviews and writings offer even more depth if you want to explore further. Thank you for joining us for this deep dive.